This is Chapter 11 in-class problem. So we incorporated the beginning of the year. We had a number of transactions. The following journal entries impacted stockholder equity during the first year of operations. And they want to know how many shares of common stock are outstanding at the year end and what's the total paid in capital at the year end. So we've got to be able to read these journal entries to understand what's going on. In A, we've got cash in for $300,000, and then our credit is common stock and paid in capital in excess of par value that sum to $300,000. So what happened here was somebody, an investor, gave us $300,000 as an investment in exchange for $300,000 of our common stock. We have par value common stock, specifically $25 par value common stock, which means that what we put into the common stock account is equal to the number of shares times the par value. Exactly. Anything that we get in excess of par value, so we should be selling our stock at or above par value. Anything that we get in excess of par value goes into the paid in capital account. So one is asking us about the number of shares. So we're playing Sherlock Holmes here, trying to back into some of these answers. But like I just said, the number of shares is the dollar amount. So we're going to do A. $250,000 is the dollar amount that we hit the common stock account for, divided by the $25 par value. So 10,000 shares. 10,000 shares. And we do that every single time there's a common stock entry, a journal entry with a common stock piece there. So in B, we've got $125,000 divided by the $25 par value. So that's 5,000 shares. So that's 5,000 shares. And then we've got $50,000 divided by the $25 par value. That's 2,000 shares. And then we've got $75,000 divided by the $25 par value. That's 3,000 shares. So how many shares of common stock are outstanding at the end of the year? We see the common stock that we sold. I don't see any journal entries for treasury stock where we brought stock back in. I don't see anything about stock dividends where we may have issued more shares as a dividend. It looks like that's everything that has to do with issuing or buying back stock. So 10 plus 5 is 15, plus 2 is 17, plus 3 is 20. And there's something else that we can figure out too. It's not part of the problem, but I think it's interesting. We can find out how much investors are paying us for our shares. We can find out the market value per share. So in A, they gave us $300,000 for 10,000 shares. And in B, they gave us $150,000 for 5,000 shares. And in C, I'm going to jump down to D. In D, they gave us $120,000 for 3,000 shares. In C, they gave us a lot of stuff. They gave us $43,000 cash, plus $15,000 in accounts receivable, plus a building worth $81,500, but we also took a mortgage on that building. So we're going to subtract that out, minus $59,500. So they give us $80,000 of cash and other stuff in C. So 80,000 for 2,000 shares. So 300 divided by 10,000 shares, 30 bucks. And $150,000 divided by 5,000 shares, 30 bucks. And then 80 divided by 2,000 shares, 40 bucks. And finally, 120,000 divided by 3,000, 40 bucks. So initially, it looks like our company was worth $30 a share. Then something must have happened. Maybe we were making money. Maybe we got a patent approved or something. I don't know what happened between B and C, and the new investors coming in C and D were paying $40 a share to invest in Kincaid. Okay, that's not part of the problem, but just to kind of get a fuller understanding of what's going on. Back to the problem. What's the total paid in capital? Paid in capital is the sum of the common stock and the additional paid in capital. Or here in this textbook, they call it paid in capital in excess. So it's just these amounts every time we issue the stock. So it's that 300, and that's 150, and that's 80, and this is 120. So you add all that stuff together, and I can see the answer. $650,000 total paid in capital. Okay, that's the first problem. Here's the next one. This is, we're Kohler Corporation, and we've got the following components of stockholder equity at the end of 2019, so that's also the beginning of 2020. And then in 2020, here's some transactions that affected the stockholder equity accounts. See, we bought back some shares, we declared a cash dividend, paid the dividend, sold some shares, sold some more shares of treasury, declared a dividend, paid the dividend, and then closed out income summary to retained earnings. So first, they want us to write the journal entries. Okay. So hopefully I have enough room here to write these journal entries right there by the transactions. On January 2nd, we bought 4,000 shares of our own stock at $20 per share. So I'm going to look back up at the top, and we've got 40,000 shares issued and outstanding. So when we've got issued and outstanding, we don't have any treasury shares. So this is the first time that we've got treasury shares here. Okay, not that it matters, I'm just curious. So $20 per share, I should be able to do this in my head. $20 per share for 4,000 shares. Remember, treasury stock is a contra equity account. So we increase it with a debit. And we spent cash, so we decrease cash with a credit. Next, the directors declare a $2 per share cash dividend. A $2 per share cash dividend. So cash dividends, or any dividend, stock dividend also, dividends are only paid on outstanding shares. We just bought back 4,000 of our shares. So there was 40,000 outstanding at the beginning of the year. We bought back 4,000 of them. So there's only 36,000 shares outstanding. So we're going to pay a $72,000 dividend. That's $2 for every outstanding share. When we declare it, remember we're under no obligation to ever pay a dividend, but when we declare it, we make ourselves obligated, legally obligated to pay it. So we're going to record that we owe this dividend payable, this cash dividend payable. When it's a cash dividend, we record it as a liability called common dividend payable. So let's see if I can squeeze this in here. We're going to call this, we're going to debit retained earnings, even though I really don't like doing that. It's just the textbook is having us do it this way. We're going to debit retained earnings. The proper account to debit would be dividends. But we're going to debit retained earnings, and we're going to credit the payable account called dividends payable. Or common dividends payable. Both of them for the $72,000. So that first one shows the dividend declared, $72,000. It goes to dividends and then retained earnings. We're just going to retained earnings directly here. And then if we were, this doesn't happen, but if we were going to declare and pay on the same day, then the credit would be cash, but we're not. So we're declaring today and we'll pay in the future. So we're going to record this liability called dividends payable for $72,000. And then now it's the future. The next transaction is the future, and this is where we get rid of the dividends payable and pay the cash, both for $72,000. Retained earnings is an equity account. When we're paying dividends, we reduce the equity account. Dividends payable is a liability account with a credit. We are increasing the liability account, but then on February 28th, we're getting rid of that liability account with a debit, and then cash. When we credit cash, that means we're spending money, spending cash. Next, on July 6th, we sold $1,500 of our treasury shares at $24 per share. So we need to remember what we bought those shares for, because that plays a huge role in the journal entry from when we reissue or sell these treasury shares. So the first piece is we brought some cash in. 1,500 shares. 1,500 shares at $24 each. So we brought in $36,000. So we're going to record cash, $36,000. Now we need to pull the treasury stock out of the treasury stock account. So what did I call it? Up top I called it treasury shares. There we go. Treasury shares. And this is 1,500 shares, and we bought them at $20 each. So $30,000. I'm going to move this over. We can see that our journal entry is not in balance. We need another credit for $6,000 for $6,000 to make this journal entry balance. And we're just going to put that into an account called Paid in Capital, Treasury Shares. So that's selling treasury stock above cost. We put that excess money that we brought in, the excess $6,000, goes into a paid in capital account. We sold some more. On August 22nd, we sold 2,500. Is that the rest of it? 4,000. So we sold the rest of the shares on August 22nd for $17 a share. We bought them at 20, we sold them at 17. So this is an example of selling treasury shares below cost. So first we brought some cash in, and that cash is 2,500 shares times $17. So we brought in $42,500. $42,500. See, I think I've got room over here. I'm going to put it over here. So we brought in $42,500, and we need to pull those treasury shares out of the treasury shares account. So I'm going to credit I created that account with a debit, $80,000, and then I hit it on July 6th for $30,000. So there's $50,000 in there, and I know I'm wiping it out because I've already said that I bought 4,000 shares. I sold 1,500 on July 6th, and I sold the other 2,500 on August 22nd. So I know I'm wiping it out. So I'm going to credit this for the $50,000. But the real way to calculate this is I'm selling $2,500 of treasury shares that I paid $20 for. So $50,000 is what I'm pulling out of the treasury shares account. Remember, treasury shares is a contra equity account that I am reducing. So I do that with a credit. Okay, I'm not in balance. I'm $7,500 out of balance. So first, I go look to see if I've got paid in capital treasury shares. If I do have that, then I'm going to pull out as much as I need. I need $7,500. I'm going to pull out as much as I need or as much as what's in there. So on July 6th, we created that account called Paid in Capital Treasury Shares with a $6,000 credit. I need to wipe the whole thing out because I need $7,500 to make this thing balance. So I'm going to debit it for the full $6,000. Oops, change my color back. Paid in capital treasury stock, $6,000. Now that account is empty, but I'm still not in balance. I need another $1,500 over here on the debit side. And I go to retained earnings. I don't like going to retained earnings, but this is one of the times where I have to go to retained earnings. There's the journal entry for August 22nd. Next, we declare a $2 per share cash dividend payable on October 28th. Oh, we declare it today on the 5th for the stockholders of record as of the 25th, and we're going to pay it on the 28th. So we declare it today, $2 per share. So we need to know how many shares we have outstanding. We started with 40,000 shares. We bought back 4,000. So that left us with 36,000 up here when we declared that dividend. But after that, we sold those treasury shares back out to the market. All of them, the whole 4,000. So we're back at 40,000 shares outstanding times the $2 dividend is an $80,000 dividend that we've declared. So just like above on January 5th, I'm going to I should be hitting my dividend account, but in this chapter, they want us to debit retained earnings, for the $80,000, and we're going to credit this payable account. Common dividend payable or dividends payable for the $80,000. Once we declare, we are obligated to pay it. And then on October 28th is when we actually pay it. So this one is where we get rid of that payable. By debiting it, it's a liability, so a debit gets rid of it, and paying out the cash. And then finally, close the credit balance in income summary. So it's got a $388,000 credit balance in income summary to retained earnings. So we want to wipe out that credit balance in income summary. So we're going to debit it. Income summary for 388, and then send it to retained earnings. So income summary has a credit balance of $388,000. We are getting rid of it, so we debit and we zero out that account and we move it over to retained earnings. That's part of the closing entries. That was from, I think it's chapter 3. I can't remember if it's 3 or 4. I think it was chapter 3. Prepare journal entries. That's done. Prepare the statement of retained earnings for the year 2020, and then the stockholder equity section. So first, retained earnings. Let's see where I can squeeze it here. Let's see if I can squeeze it right here. We're going to start off with retained earnings beginning balance. And we get that from up here. plus our net income. And that was that last, that's why we had that last journal entry, that last transaction that seems like it didn't fit with the rest of them. That was our net income. Part of the closing process, we move everything that's in a revenue account to income summary, and then we move everything that's in an expense account to income summary. And income summary then has the same balance as our net income. And then we move everything out of income summary over to retained earnings. So net income for this year was $388,000 minus dividends. And our dividends were there. And we had another one here. So 72,000 and 80,000. $152,000 was our dividends. And normally that's it. But if we go through here looking for every time we hit the retained earnings account, see, we hit it there for the dividend, and we hit it here for the dividend, and we hit it here for the net income, and we hit it here because of the treasury stock. So we need to record that also. It's a debit. So just like the dividends that are debits to retained earnings, this is a subtraction. Less treasury shares reissued. $1,500. And then that leaves us with retained earnings, ending balance. So that's 270 and 388 minus 152 minus 1,500. 504,500. That is the statement of retained earnings. And then the stockholder equity section is what they want next. So the stockholder equity section is going to show our ending balances in the two paid-in accounts, which would be, or any paid-in accounts, but here we've got common stock and paid-in capital in excess of par value common stock. We would also put in treasury and the paid-in in excess treasury, but we wiped both of those out. And then retained earnings also goes in here. So we're going to put the common stock, ending balance. We're going to put in the paid-in capital, ending balance, and we are going to include retained earnings. Because the equity section is both the paid-in capital and the earned capital. Retained earnings we just calculated. So the common stock. We started with 400. We bought back 4,000 treasury shares, but then we sold it again. And we didn't issue any more shares. So we're still at $400,000. The total paid in capital in excess par value, $60,000. We would only increase that if we issued more shares at greater than par value. We didn't issue any shares. We reissued treasury shares and we took care of that, but we didn't issue any new shares. So that also just stays at the $60,000. So that's it. We've got 400 and 60,000 and 504, 500. So 964, 500 is our total of equity in this balance sheet. This is just a piece of it. We're missing all of the asset section and all of the liability section, but this is the equity section in the balance sheet. Next, we've got Beijing Company. So at the end of the third quarter, we've got the following equity account balances: common stock, paid in capital, retained earnings. And then during the fourth quarter, here are some events. Here are the journal entries for some events that happened. Looks like we declared and then paid a dividend on the 2nd and 25th. It looks like we declared a stock dividend on the 31st and paid it on November 5th. And a memo, it's not a journal entry. We changed the par value. And then we moved revenue to income summary, expenses to income summary, and then income summary to retained earnings. So we closed out the income statement at the end of the year. So what it's telling us, or what it's asking us to do, is to fill in the account balances of the equity section at the different time periods in the fourth quarter. So we start off with September 30th, and that's the given information up top. So common stock, $360,000. And we didn't have any dividend distributable. And there was already the $90,000 of paid in capital in excess. And we already had $320,000 of retained earnings. And if we add all of that together, we get total equity of $770,000. So how does that change on October 2nd? On October 2nd, we declare a dividend. Retained earnings is an equity account that we are reducing because of the dividend. Common dividends payable is a liability account that we're increasing because we owe this dividend. This is what they're asking us for, are just equity account balances, so that common dividend payable doesn't affect anything here. So we're reducing retained earnings by $60,000. So it was $320. I should probably be able to do this in my head. and we are reducing it by $60,000. So now it is $260,000. Nothing else changed. We haven't issued any more common stock. Common stock dividend distributable is if this had been a stock dividend instead of a cash dividend. So nothing changes there. And paid in capital in excess, nothing changes there. So now our total is the 360 and the 90 and 260 for $710,000. On the 25th, we are getting rid of the liability with a debit and spending cash to pay that liability for the dividend. Neither one of those are equity accounts, so nothing changes. On the 31st, we are paying a stock dividend. We are paying a $75,000 stock dividend. And our common shares, they're not really giving us much here. We have to kind of Sherlock our way into this thing. Our par value is $12. So when we're hitting common stock dividend distributable, that's what we're eventually going to put into the common stock account for the additional shares that we're issuing, because this is a stock dividend. A stock dividend is when we issue new shares and pass them out to our shareholders in the same proportion of ownership interest that they already have. So if you own 10 shares, maybe I give you one more share for every 10 shares. So I can use that piece of information, the fact that I'm hitting my the common stock. Eventually I'm going to hit my common stock account for $36,000, and our par value is 12. This is 3,000 shares. 3,000 shares that that I'm paying out as a dividend. And up here at the top, we can see that there's 360,000 in the common stock right now at $12 par. So there's 30,000. There's $30,000 shares that we have issued and outstanding right now. So this is a 10%. This is a 10% stock dividend. 25% is the threshold between small and large. This is a small stock dividend. So we're using the market value to help us determine that dividend amount, the $75,000. So the market value, and this is more than this problem is asking, but other problems may ask you this. So the $75,000 that we're hitting retained earnings for is for 3,000 shares. So our market value right now must be $25 a share. This is a small stock dividend. We use market value to help us record it. So 3,000 shares, it's a 10%. 10% of 30,000 is 3,000 shares. 3,000 shares times market value of $25 a share is where the $75,000 dividend amount came from that we're hitting retained earnings for on October 31st. We only hit the common stock for par value times the number of shares. So par value is $12, and we've calculated that this is 3,000 shares. So $12 times 3,000 shares is the $36,000 that we are going to eventually credit common stock for. That's issuing the shares. Right now, because this is just the declaration, we're not actually paying the dividend right now. We are going to credit account called Common Stock Dividend Distributable. That is an equity account. That is not a liability account. It's very similar to the liability account that we use when we're paying a cash dividend, but because this is a stock dividend, we're using an equity account. And then the excess amount. We've got a debit to retained earnings for $75,000, a credit to the stock distributable account for the stock dividend distributable account for $36,000. We are missing a $39,000 credit. That $39,000 credit is the plug. We just plug it right to paid in capital in excess of par. So that's what's going on October 31st. All three of those are equity accounts. So we are going to debit retained earnings for $75,000. That is a decrease. So retained earnings is sitting at $260,000 on the 25th. We're going to reduce it by $75,000. So now it's going to be at $185,000. And we didn't hit the common stock account on October 31st, but we did hit common stock dividend distributable for $36,000. The common stock remains the same. And the paid in capital, we increased that by $39,000. So it was at $90,000, and we've added another $39,000 to it. So now the balance is $129,000. And our total equity is the $360 and the $36, $129 and $185, $710. It's the same amount. The total is the same amount as October 25th. Because all we've done with the October 31st journal entry is move balances around all within the equity account. So all within the equity section. All three of those, retained earnings, common stock dividend distributable, and paid in capital in excess of par value, are all equity accounts. So we've just moved balances all within the equity section. So our total equity section remains unchanged at $710. On November 5th, we pay the dividend. Here, this is a stock dividend. So instead of crediting cash, because we're not sending cash out, we credit common stock. We're sending more shares of common stock out. This is an equity account that we're increasing. For that $36,000, the 3,000 shares at $12 a share. That's what we've just issued. And then we get rid of that distributable, dividend distributable account of the $36,000. So here, this is an equity account that we're getting rid of. So on November 5th, our common stock account goes up by $36,000. $396. And our dividend distributable account goes down by $36,000, back to zero. The other accounts don't change because we didn't hit any other accounts on November 5th. So we still have the 129 and the 185. And again, all we did was move balances around within the equity section. So the total equity stays the same. You can double check me by adding that down, but the total equity stays the same. On December 1st, we changed the par value. So there isn't any changes to any balances. It was just a change, and I say just, it's important, but in the dollar amounts in the accounts, nothing's changed there. So everything remains the same. These balances just carry over. And then on December 31st, we close out the income summary to retained earnings. Retained earnings is an equity account. When we credit it, we are increasing it. So we're going to increase retained earnings by $210,000. So we're going to bring it up to $395,000. But we didn't hit the common stock account. That stays at $396,000. Or dividend distributable, or paid in capital in excess. So now we just add the $395,000 and the $129,000 and the I'm going to do that again because I'm not sure what I did. We're going to add a $396,000 and $129,000 and $395,000. $920,000 is our new total equity balance. This is our last problem. Here we are Atticus Group, and we've got stockholder equity balances at the beginning of the year, January 1st, and the end of the year, December 31st. Common stock 160 went up to 189,600, so something happened in common stock. We can also see we started off with 40,000 shares issued and outstanding, but we finish with 47,400 issued, 3,000 in treasury. So we know that that means that there is 47 minus 3 is 44. That means there is 44,400 outstanding. So we had some movement there in the common shares. Let's see, paid in capital in excess was started at 120, ended at 179,200. So we had some movement there. I'm going to move this, so I'm going to move this up here. Oop. I can do better. I'm going to move this up here so it looks like it's out of the way. There we go. And then retained earnings, we started at 320 and finished at 400, so something happened there. Excuse me. And then we've got treasury stock, where we didn't before. So we know something happened with treasury stock. Okay, there's our beginning and our ending. Following transactions happened. So we declared a cash dividend on the 5th of January. And 20th of March, we bought back treasury stock for cash. April 5th, we declared another cash dividend. July 5th, another cash dividend. July 31st, a 20% stock dividend. Remember, 25 is the threshold. 25 or less is small, more than 25 is large. This is a small stock dividend. The 14th, we issued the stock. On the 5th, another cash dividend declared. Okay, So what do they want from us? How many common shares are outstanding on each cash dividend date? Okay, so we're looking for the cash dividend dates. Cash dividend, cash dividend, cash dividend. That's a stock dividend. There's a cash dividend. So we've got 4 cash dividend dates. And they want to know common shares outstanding. And hopefully we know exactly why they're asking for common shares outstanding. Because cash dividends are paid only on outstanding shares. So it's 50 cents a share times we need to know how many shares are outstanding. Okay. So on January 5th, here's where we started the year with 40,000 shares issued and outstanding. We want outstanding. So 40,000 shares outstanding. And then on March 20th, we purchased treasury stock for cash. Is there any more treasury stock movement? April 5th is cash dividend, July 5th is cash dividend, July 31st is stock dividend, August 14th is when we paid the stock, and then another cash dividend on October 5th. So all we did was buy back some treasury stock. That's it. One time, bought back treasury stock. We didn't buy any more later during the year. We didn't sell any of it during the year. So then at the end of the year, we can see that 3,000 shares are in treasury stock. So that's what we bought back on March 20th. So that means that on April 5th, it's 40,000 shares minus 3,000. So 37,000 shares outstanding. And nothing happened between April 5th and July 5th, so it's the same 37,000 shares outstanding. The 40,000 issued minus the 3,000 that we repurchased on March 20th gets us to 37,000 shares on April 5th and July 5th. So on July 31st, a 20% stock dividend. So 37,000 shares times 20%. 7,400 shares is what we issued here with this stock dividend. So by October 5th, there's another 7,400 shares out there. So 37,000 plus the 7,400. So 44,400 shares outstanding. Okay, how many common shares outstanding at each dividend date? 40, 37, 37, and 44,400. Next, what is the total dollar amount for each of the 4 cash dividends? Kind of knew they might ask us that because they had asked us for the shares outstanding. Can I do this in my head? I can do that one in my head. Maybe not that one. 18,500. 18,500. And 22,200. That's the dollar amount of the cash dividend that we paid on those 4 cash dividend dates. Next, what's the amount of retained earnings transferred to paid in capital accounts for the stock dividend? So how much did we record in additional common stock and I say additional common stock. How much more did we record into common stock, and how much more did we record into paid in capital in excess because of the 20% stock dividend? Small and large tell us which dollar amount to use times the number of shares. So when it's a small stock dividend, we use market value. When it's a large stock dividend, we use par value. This is a small stock dividend. 25% is the threshold. We're at a 20% stock dividend. So we're going to use market value. So $12 per share times 7,400 shares is what we issued. 88,800. That's going to be split up between common shares and paid in excess, paid in capital in excess of par. But they're asking us for the sum of those two, so we don't have to split it up. What is the per share cost of the treasury stock purchased? What is the per share cost of the treasury stock purchased? So what have we figured out already? We figured out that on March 20th, when we purchased the treasury stock, it was 3,000 shares. Times, oh, not times, because it would be 3,000 shares times the cost, the per share cost would get us the total amount. They're asking us. So we need the total cost. It's right there. We need the total cost of treasury stock. So there's our calculation. Okay, I'm going to keep trying till I get this right. There we go. Our calculation is $30,000 is the total amount that we've spent for 3,000 shares. I should be able to do this one in my head, right? $10 a share. We bought the shares back at $10 a share. How much net income did the company earn this year? How much net income did the company earn this year? They really have us playing Sherlock Holmes on this. Okay, how much net income? We're going to look at the retained earnings. We're going to rebuild, or we're going to build as much as we can of the statement of retained earnings because net income is in there. So the statement of retained earnings, I'm going to write it over here. So I have plenty of room. As a matter of fact, I'm going to put the $10 answer right there. And I'm going to try and use all of this room here. Okay, we're going to start off with beginning. The retained earnings beginning balance. And that is given right here. Plus net income. Oh, that's what they're asking us. So we don't know what that is. Minus dividends. So here is where we subtract out all of those dividends that we paid this year. And that includes the stock dividend. And here's the benefit. I'm still not going to admit that I like what the textbook is doing in this chapter. But here's the benefit. We didn't write out the journal entries, but we've seen the journal entries enough to know that for everything I've just highlighted, the 4 cash dividends and the 1 stock dividend, the journal entry for all of these in this chapter, not the right way of doing it, but in this chapter, is a debit to retained earnings for 20 or 18.5 or 18.5 or 22.200, or for the stock dividend 88.800. So we're going to debit retained earnings for the dividend amount, whether it's a cash dividend or a stock dividend. All of that added together is our total dividends. So let's see what we paid out in dividends. 20 and 18,500 and 18,500 again, and 22,200 and 88,800. So we paid $168,000 in dividends. What was it? Oh, 168 even. Equals retained earnings ending balance. And we have that number here. Okay, so let's see what we got. We've got a beginning balance of $320,000 minus our dividends. So $152,000 is our balance without considering net income. Our real balance is $400,000. So our net income is whatever amount moves us from 152 up to 400. So I'm going to find the difference between 400 and 152. $248,000. So I think this is $248,000. Let's do the math and see if it works. 320 plus 248 minus 168 equals 400. So $248,000 is net income this year. And that's it.